We want to introduce Investopedia Editor-in-Chief Caleb Silver, and for more on the market reaction, Brian Belsky, BMO Capital Markets Managing Director and Chief Investment Strategist, who joins us on the telephone. There was a note yesterday from Sequoia, Brian, that warned investors that get ready. This could take several quarters just for markets to stabilize, and then several more quarters for there to be some kind of economic recovery. Is this hyperbole? Was that an overreaction, or are markets now coming in line with what could be a prolonged event from coronavirus?
Well, good morning, Adam. I would say this. We cannot speak to the process or discipline of Sequoia in terms of how they came up with their conclusions. I can just speak to what we believe with respect to how we invest and where our models are saying. Sure. Frankly, anyone that came out 3 or 4 weeks ago and changed their numbers and their forecast based on coronavirus, we'll give them a tip of the cap and pat them on the back. If strategists and economists are changing their forecast today and yesterday, I think that's a bit reactive and not really showing the confidence that I think we should show with respect to the United States stock market, the economy. As we know, 70% or more is the consumer, and through this, the consumer has held in there. Now, we don't know exactly what the facts are. We are dealing every day with different facts. And so I just think it's way too premature to either call a bottom or call for Armageddon. And for those to use things like black swan and these types of labels, I firmly do not agree with it.
So, Brian, what are you doing then? In other words, are you just kind of sitting back and watching and trying to gather as much data and information as you can, and then sort of not change any of your targets, any of your estimates, whether it's for your S&P targets for year end or your economic targets or your corporate profitability targets? Are you just waiting?
That's a great question, Julie, and good morning to you as well. Our great economics team adjusted their first half GDP down slightly, but up their GDP for the second half. You know, all in all, the math still holds true that they're still seeing the same growth rate. And when you have a bond market, as you know, following it for several years, when you see you see 10-year treasuries hitting below 1%, all-time lows, that changes your models with respect to how you look at dividend discount models. And so the risk premium and clearly the risk-free rate changes, and then that favors more risk stocks. It's not the only model that we use in terms of looking at the market. But at the end of the day, we run year-end targets, and we look at the market. In the portfolios that we run for our private clients in Canada and the United States on a rolling 12 to 18-month basis. And I'm here to say I have not sold a stock. I have not sold a stock in any of the portfolios that we run, principally because we believe in the holdings that we have. If you liked XYZ stock 14 days ago, you like it a lot better now. And I firmly believe that it's way too soon to jump on the negative train until we actually see the actual impact in the numbers. And by then, the market, we believe, could be recovering. So it could be a moot point.
Hey, Brian, you brought up the consumer earlier on, and the consumer is 2/3 of GDP. At what point do we start to see the weakness in retailers? And I'm not talking about the Costco's that are selling the Purells, but if we see that broader weakness, restaurants start to slow, concert venues are slowing, people aren't going out, at what point does that bleed into your forecast and really start to take down the U.S. GDP?
It's a great question, but if you take a look at the consumer discretionary sector in general, buying has become quite concentrated in kind of 3 buckets, right? It's the Costco bucket, it's the Amazon bucket, and what we like to call from a thematic basis, the lifestyle bucket. And we haven't seen lifestyle change yet in terms of going to Lululemon or going to Starbucks or going to Dunkin' Donuts. I mean, that's been ingrained now in our culture, and they're becoming increasingly elastic. Costco clearly is in the headlines with people on a run on toilet paper and bleach and all that kind of. These are near-term phenomenons. I'm actually would be more inclined to be selling into these parabolic moves in Clorox and Kimberly-Clark and some of these names that we think can't justify the fundamentals in the valuations at this time. So the consumer, quite frankly, has become so much better in terms of how they're buying things. We just have this panic and emotionally driven. So I don't. It's not like 2008 where we had systemic structural issues with the consumer based on credit. This is a very short-term phenomenon. If those of you that weren't in the market in 2008, that was several months and several quarters in the making.
All right, Brian Belsky, BMO Capital Markets, thank you for being here.